I would now like to turn the podium over to Wright-Hennepin's Chief Financial Officer, Angie Pribyl.
Good evening. Chair Lanto, President Vogt, and I all plan to keep our reports very short tonight so that we can make time for the wonderful history video you will see in a few minutes, and still keep our business meeting to about 1 hour, the time frame you've said you like. To summarize the year 2011, I'm pleased to tell you that Wright-Hennepin is in very solid financial condition on its 75th anniversary, as it has been every year since 1937. I will begin with the December 31st, 2011 balance sheet. If you'd like to follow along, please refer to the top of page 6 in your program, page 6. Line 1. Total utility plant assets 2011, ending balance of $146.8 million. Net growth over 2010 of $4.2 million. Line 10, other property and investments, almost $38 million. The vast majority of this, over $30 million, represents our share of Great River Energy and Basin patronage allocations, which in turn have been allocated to you in the form of capital credits. Line 17, total current assets, $24 million, which includes $12 million of strong cash levels. Line 19, total assets, December 31st, 2011, the book value of your business, $168,482,089. Line 22, total members' equity, your ownership in the business, almost $70 million. The majority of it is allocated to you, the member. Of the $70 million equity, more than $27 million is from our power suppliers, Great River Energy and Basin Electric. Line 28, long-term debt, $77 million, which is Wright-Hennepin's mortgage on the $146.8 million investment in plant made up of poles, wire, meters, transformers, substations, etc. Line 36, total members' equity and liabilities equaling total assets, $168,482,089. Turning to the operating statement, also found on page 6 in your program. Line 51, operating revenues, $83.7 million. Line 52, cost of power, Wright-Hennepin's single largest expense, 72% of revenues, $60 million. Line 56, local operating expenses, $11.4 million. These are the costs to run our local operation here at Rockford and the distribution system we've built in Wright and Hennepin counties. Line 60, fixed charges, $10.3 million, comprised of property taxes, depreciation, and interest. Line 61, net operating margins. All this leaves us with a margin after expenses of $1.7 million. Line 62, conservation improvement program, $550,000. This is state-mandated spending towards conservation and energy efficiency programs for our members. Line 63, non-operating margins, more than $600,000. These margins include interest income as well as profits from the diversified businesses held within WH Holding Company, one of the unique real advantages we built over the years to help keep your price for electricity affordable and competitive. Line 65, generation and transmission, and other capital credits is Wright-Hennepin's portion of the annual patronage allocation from our power suppliers as well as our lenders, $2.7 million. The majority of the $2.7 million has been allocated to your individual capital credit accounts along with past year's allocations. Line 66, net margins, our consolidated bottom line for 2011, $4,522,556, an excellent margin while providing you with competitively priced and high reliability electric service. Per the bylaws, this $4.5 million will be returned to you in the form of capital credits. In fact, the board plans to retire a portion of these 2011 margins to you already at the end of this year during the holiday season, just as they have for the past 12 years. To summarize 2011, your cooperative is in excellent financial condition. It is providing competitive retail rates. We continue to invest to keep the reliability of the electric grid among the highest in the industry, and Wright-Hennepin is meeting its obligations of returning margins to you over and above the cost of service. And that is exactly the promise Wright-Hennepin's pioneers made 75 years ago. We would be pleased to entertain any questions or comments which you may have about the financial report.